Good evening, everybody. It's great to be back here presenting again. Want to talk about the Global Equity Fund and really do this in two parts. One, focusing on our investment strategy, which is slightly different and unique strategy in the way we invest, but also then going on to our views on market and how the fund is currently positioned. So, first of all, one of the main challenges of investing is that, in a way, it's like trying to predict the future, which, as any fortune teller will tell you just after you paid, is an inexact science. So, what do we do to try to help us in that regard? What we try to do is, one, focus on probabilities in terms of our investment, looking at different scenarios. But then more importantly, what we try to do is look for value. We try to buy stuff cheaply. And that's really at the core of the investment strategy that is utilized by the Global Equity Fund. And what we do within this fund and this strategy is we buy closed-end funds. And I'm going to go into a little bit of detail as to what that is and what that means. Beforehand, I just want to talk through our investment process, which is on the second slide. We have a separate macroeconomic team at City of London, which looks at economies, global economies, markets around the world, and they look at all the macroeconomic factors, all the market factors, and based on that, using a 12-month forward-looking view, they provide a ranking of countries that they expect to be the best performers among global equity markets. What we then do is we overlay that process in stage 3 of our process, where we're looking at the value available within our closed-end funds. And based on where the value is, we'll adjust those pure economic market forecasts of macroeconomic forecasts of market returns based on the value we can access using our closed-end funds. So slide 3, just going on. So what is a closed-end fund? A closed-end fund is effectively a pool of investment assets, very much like the Tradex Global Equity Fund is a pool of investment assets. The Tradex Global Equity Fund is an open-end fund. That means on any given day you can buy units of the fund at net asset value and you can sell units of the fund at net asset value. And the net asset value is the underlying market value of the portfolio divided by the number of units in existence. For a closed-end fund is launched at a given point in time. It has an initial public offering on a stock market which raises the investment pool, and a fixed number of shares are sold. And so that number of shares does not vary. So you cannot go to the closed-end fund manager on an even day and say, I want my money back at NAV, at net asset value. The shares themselves are listed on a stock exchange, and the price at which they trade on the stock exchange is dependent on the supply and demand for that security. So at any given point in time, that closed-end fund can trade at a premium to its net asset value, meaning you're paying more for the stock than it's actually worth, or it can trade at a discount to net asset value, so you're paying less than it's worth, its underlying worth, at that point in time. And those discounts and premiums on each of the closed-end funds that we follow vary over time. So at points in time, we may be able to buy a fund at a 10% discount. Other points in time, that same fund could sell for a 2% premium. So what we're looking at when we're looking at these closed-end funds is trying to identify where we can buy the cheapest exposure for that fund. Slide 4, we talk about the advantages of closed-end funds. Why do we use closed-end funds, and why do we think this is a good investment medium for a global equity strategy? The primary reason is that these closed-end funds exhibit that discount volatility. So those discounts move up and down at a time. So each one of these funds is managed by a professional investment manager and delivers a return stream. So if that, say it's a UK equity fund, if that UK equity fund on its net asset value just delivers the performance of the underlying UK market, but we buy it at a 10% discount and then sell it at a 5% discount, then our investment will have made a 500 basis point return above the underlying index performance. And that's what we're trying to do in this portfolio over and over again with different securities. And if you do that each time, and each time you make an investment, you add 500 basis points over the underlying net asset value, then you're going to generate a return above the benchmark from that discount element. Secondly, why we use closed-end funds. The closed-end fund structure aids in investment managers' performance. So these professional investors who manage the portfolios of closed-end funds like the closed-end fund structure. It gives them a fixed pool of capital which allows them to make long-term investment decisions. And as one investment manager of a closed-end fund described, this is investment nirvana, because it means you don't have flows in and out of the fund each day. You can just take your positions and have the longevity to be able to see those positions come to fruition. From a closed-end fund, you also get a portfolio of closed-end fund. You also get a very diversified underlying portfolio. Each of these closed-end funds have around 50 to 60 individual securities within their investment portfolio. We have a portfolio of around 50 closed-end funds. So overall, you've got approximately 3,000 securities underlying that full portfolio. So your individual stock-specific risk is very low within this strategy. As I mentioned, these are all professionally managed pools, so you're accessing managers much like you are in other Tradex and mutual funds. And also, closed-end funds, by their nature, allow us to be very fast and flexible in terms of asset allocation. If we decide that we want to reduce the exposure to a particular market, oftentimes that just means us selling one particular security. Slide 5, which I don't expect you to be able to see on here, but it's in your pack. This is really just giving a sample of funds, closed-end funds that we look at and we invest in, or are part of our investable universe. And it really just shows these discount ranges over a market cycle, which we've taken as a 7-year period. And as you can see, if you just look at these securities, the range of discounts at which these trades are pretty wide, and that gives us the opportunity to add return from these discounts, this discount volatility. Slide 6 provides an example of this. The Henderson European Focus Trust is a closed-end fund that we've owned within the Tradex Global Equity Fund. This is a fund that was originally managed by an investment management company called Gartmore. Gartmore ran into some issues and got purchased by Henderson Global Investors. And at this point, there was a lot of uncertainty about this fund in terms of who was going to be managing the portfolio. That resulted in the discount widening substantially. As you can see from this top chart, it went from roughly a 4 or 5% discount right out to a 15% discount. At that point, we started purchasing this security for your account. And this is also a fund, if you look at the bottom chart, where the net asset value performance has been in excess of the benchmark as well. So a new manager was put in place, a gentleman called John Bennett, who works for Henderson Global Investors. He actually was previously at Gartmore as well. And since that time, there's been positive NAV performance. So this fund has really done well in terms of providing return, and that discount has narrowed substantially. And as it's narrowed, we have sold some of those shares just to crystallize that gain for the portfolio. A second example is British Empire Securities. This is, again, a fund which it's worth looking at the chart at the bottom first, because If you go back to mid-2011 and then kind of go forward a year to June 2012, you'll notice that the yellow net asset value performance line substantially underperforms, meaning it slopes downward more steeply, the underlying benchmark index. At the same time, if you look at the chart above, that discount on that security widened out substantially. So this is a situation that we find over and over again in our closed-end fund universe, that a fund which has a good long-term performance track record has a period of poor performance. That results in the discount widening, and then what often happens is that the net asset value performance will turn around, and if you look at that yellow line for the next period of a year, it outperforms its benchmark, so you get that reversion to the mean from this strategy as the NAV performance reverts to the mean of its long-term investment trend. So with this security, we added to the position significantly as that discount widened. As it narrowed after that period of good performance, we sold some shares, and again, it has widened out again, and we've added some shares back. So this is really just gives you a flavor of how we invest in and out of these discounts and take advantage of these changing discount levels over time. So with that, just want to review the performance of the fund, which over the last year, over 2012, outperformed the benchmark by 1.73%. 2013, we've given all of that up. We're down 2.15% at the end of the first quarter. And what we provide at the bottom of the page here is attribution. Why have we performed the way we have? And we like to break this down so you can get a sense. If you look at this bottom table, you'll see that it's broken down into 4 elements: country allocation and currency movements, NAV performances, and discount movements. So discount movements, you'll see that all elements of that is positive. So we have done a good job making money for this portfolio from discounts. The bad news is we've done a terrible job from country allocation and currency allocation. And that really has particularly in the first quarter of this year, and I'll get into why that is, has really affected the returns of this account. In addition, the underlying net asset value performances of some of the funds that we've invested have failed to keep up with the benchmark, and that again has detracted from returns. And that is principally two elements that's contributing to that NAV underperformance. The first is that we've had an overweight to mining securities, and that has clearly, as I'm sure many of you know, not been a good decision. And secondly, it's been a number of our US closed-end funds have underperformed their respective benchmarks, and that's how that NAV performance has been generated. If we go on to slide 9, this just shows market and currency performances for the last year, and you'll see that what we call the developed markets outlined by the MSCI World Index returned significantly more than the MSCI Emerging Markets Index, which is also highlighted in yellow. This is one of the key allocations that we have within this strategy right now. We are underweight to the US market, and meaning we've got less exposure to the US market than the benchmark, and we are overweight to emerging markets. And clearly over the past year, that has not been the right place to be invested in. Also of note on this page is the performance of the currency returns. The Japanese yen, with the recent activities of the Japanese central bank, has also resulted in a sharp decline in that currency. So global equity overview in terms of where we are right now and how we're thinking about the markets. Effectively, as other managers said, global growth continues to be very low. The global growth rate's around 1.5%, and that obviously is a lot below the average that we've seen. We have seen US growth has been a little better, but the question is whether that is sustainable. We've seen some improvement on housing, and we'll get into that on the next slide. We do still think that global equities as an asset class are the place to be. We think they're much more attractive than bonds and cash, and that's really due to the activities of central banks around the world. Equity valuations still are not that expensive. Equities have done very well since the market bottom in March 2009, but corporate profits are also a lot up, have increased a lot, and valuations are lower based on that. As I mentioned, the activities of central banks have really been the key aspect that's been driving the markets. We've had the US Federal Reserve has been undertaking its quantitative easing program, is now on a continuous purchasing program each month with no set end date, which is unlike their first two bouts of this quantitative easing. And now we have the Bank of Japan, who are starting to print a lot of money as well. And this is really driving equity markets, because what these central banks are trying to do is suppress savings rates in each of these countries. What they want you to do is they are punishing savers. They want savers to take their money out of safe assets and put them into risk assets, meaning equity markets. And pretty much it's going to work. And it has been working in terms of the equity markets. And we would expect that to continue. What we also see, corporations are generating a lot of profits. They've got a lot of cash. So that's supporting share buybacks. It's also supporting increased dividends and also merger activity as well. And that increased dividends is really, if you look at what stocks have really been performing, it's been, you know, those dividend-paying stocks. Everybody loves those dividend-paying stocks. So, because that's just a way that people can get income now. They can't get income from bonds or traditional areas, so being driven into these dividend-paying stocks. And then the final point on here, currency wars heating up. Because everybody's monetary policy now is very easy monetary policy. So what's the way that the mechanism that people have to help their economies if they can't do anything fiscally because they're all in debt, they can't do anything monetarily, they want a depreciating currency. Depreciating currency can help the export market, but unfortunately everybody wants a depreciating currency. And what's happening right now is that you've got the US printing a lot of money, you've got Japan now going to print a lot of money, so, and then you've got poor old Europe who can't agree to print more money, and their currency is a lot stronger than they would like it to be. So one thing which could occur is that, you know, the ECB, the European Central Bank, they start doing some more money printing. And if they do, everybody's going to kind of want to continue doing this, and it's going to drive up equity markets. In terms of the regional outlook, as I say, US has been the outperformer, and this quarter in particular, which has hurt our performance considerably. The US has outperformed, the emerging markets have not outperformed. We think a lot of good news is priced into the US. US has had a depreciating dollar for an extended period of time. They've been the most aggressive monetary easers for a period of time, but now you've got other countries that are trying to ease more, and we think that sustainability of dollar weakness is, particularly with the US exhibiting one of the stronger growth rates in the developed world, is the dollar's likely to appreciate from here. You know, you see the unemployment rate, so you say, okay, great, the unemployment rate in the US is falling. It's not really because there's a lot more people employed, it's because a lot of people have given up looking for jobs. And there's the fiscal issues. We've had the payroll tax increase and the sequester spending cuts, and really the data at the beginning of the year, economic data was looking good, but we're now seeing some weakness in that US data. So it's just questioning whether that is going to continue. I also have doubts about the sustainability of the housing market increases. What we're seeing is we are seeing some house building in the US, but this is multi-unit house building. Single family house building is not growing. And so, and as you have, from a demographic point of view, a large amount of the baby boomer generation who haven't saved enough for their retirement, retiring, I just see more people moving out of those large single family homes, and that basically being a drag on the market. So anyway, US from a valuation point, we also think is relatively expensive. Eurozone, it is lurching from crisis to crisis, and it has a currency which is too strong for most of the Eurozone area. So we think that's going to hurt growth. But again, if we see some central bank activity there, that could help the Eurozone as well. UK, we still have a lot of austerity within the country. Japan, we're seeing this big experiment with printing a lot of money to try to get the inflation rate up. I think that equity markets in Japan will probably do pretty well and have been doing pretty well, but I do wonder whether this is actually going to feed through to better growth in Japan. Scandinavia and Switzerland have really been a kind of Eurozone place to hide, but again, those valuations in those countries look pretty rich to us. Australia really is a divided market in that you have some very cheap resource stocks there, but very expensive banks. And so we have some exposure to the mining stocks, but that market we are avoiding otherwise, and also there is not a lot of value within our closed-end funds. Emerging markets is really a China story. China has been seeing its growth rate slowing, but you are seeing really a different composition of growth within the Chinese economy, movement to more of a consumption-oriented economy, and with still a lot of investment activity, and we expect that investment activity to continue, but the focus is more on the central and western areas of China as opposed to the eastern area, which has been pretty well built out. Market valuations, just included this page. Bottom line is we think the US markets are relatively expensive. We think there's good value within the European markets, and also in particular the emerging markets. Slide 13 just gives a summary of where we're positioned right now. We have an overweight to the UK market. That's really a function I've said before. The UK stock market is really not that representative of the UK economy. It's more of a global stock market, and so and the reason we have that overweight is really a closed-end fund factor, where there's significant value in a number of closed-end funds within the UK that offer UK market exposure. We are overweight to those emerging markets. Underweight, we're underweight to the USA, and expect to continue to be underweight to the USA. Japan is a country that at the beginning of the year we had moved to an overweight position. As that market has performed well, we have sold some of our securities that we have that give Japan exposure. We were a little too early in that, but it is a market that we think will do well, so we would be looking for opportunities to increase that exposure as well. The remaining slides, we give our country allocation, which just reflects the chart that I just gave you. Slide 15, we've got our size-weighted average discount, which is that 11.8%. This has come down over the last year, and that really reflects some narrowing of discounts within our European closed-end funds, and also we held a number of private equity closed-end funds, private equity fund of funds, which themselves have narrowed in discount. And the remaining slides just give some information about our securities, our portfolio, and reasons why we hold those securities. I'm not going to go through that, but it's there for your review. And then just to summarize on slide 19, we are very much a value-oriented strategy. We use closed-end funds as our investment medium. We're focused on exploiting those discounts that the closed-end funds trade at. It's a very diversified approach which helps reduce the overall risk. And our key allocation decisions right now is that we're overweight emerging markets and we're underweight to the USA.